This is the Alhambra Investments Weekly Pulse, where we talk about things that happened last week, some observations, and Joe Calhoun is here. You know, Joe, last week we had a conversation a little bit about cryptocurrency, and some things that you predicted came true when Elon Musk sacrificed Dogecoin Saturday night on Saturday Night Live.
Yeah, I don't know that I predicted very much. I just thought it was ridiculous last week, and Elon Musk proved that it was ridiculous over the weekend. Yeah, I think that if the outcome of your investment program is dependent on what gets said on Saturday Night Live, you might want to rethink your strategy. Let's put it that way, because it didn't work out too well for you. You went into Saturday night at about 72 cents, and you come out this morning at 40 something cents, down by about a third. I don't know. The whole thing is a joke. I don't know why anybody would take it seriously to begin with.
Well, Musk even said that it was a joke, or he called it a hustle on Saturday Night Live.
A hustle, which, as I said in the piece too, what does that make him? Hustler in chief? I don't know. I still can't believe actually that there's not some regulatory angle here that the SEC might want to speak to Mr. Musk about his promotion or whatever you want to call it of the Dogecoin thing on Twitter. I got to tell you, I think there's a lot of things that happen on Twitter that I think go well beyond what we used to call talking your book. You know, you'd see these guys come on CNBC, mutual fund managers and so forth, and they talk about all the stuff that they own, which is fine. But I think things have gone beyond that on Twitter. And I think the SEC ought to take a really close look at what influencers, that's the new word, what influencers are doing on Twitter when it comes to stocks and other types of investments, particularly these really speculative ones like cryptocurrencies.
Well, you're talking about the SEC and the government. We're in an age of a new age of big government, and it just seems like big government's taking us nowhere.
Well, yeah, apparently it is big government. We're certainly going to be spending a lot of money, but whether they spend it in the right places or not, I guess is the question. And I think there probably are some enforcement issues when it comes to investments. I think you get in these speculative periods like this, and there's always something shady going on. But anyway, yeah, the era of big government. I said that because if you remember back in the 90s, I think it was in 1995. State of the Union address, Bill Clinton very famously said the era of big government is over. Well, apparently we're back because our government is expanding to fill the available space, which apparently is pretty big. I don't know. There's this whole discussion about whether the deficits matter, modern monetary theory, and all these things. And quite frankly, I think that really misses the point. Deficits are not the issue when it comes to government. The issue is spending. Government spending is not a stimulus. It baffles me why people don't remember that government is a cost. It is not a benefit. It is a cost to having a civilized society. And while we want to have a robust government that does provide that civilized society, I think there is once you go past a certain limit, once you go past a certain point, you're no longer doing that. So I think you got to, like anything else in life, you got to have a cost benefit analysis. And I think our costs right now are running way beyond benefits.
Well, we're not seeing a lot in the market concerning big government and its effect, but talk to me about what you're seeing now between bonds on the one side that's saying one thing, and then you get stocks and commodities saying something completely different on the other.
Well, it seems that way. You see stocks going up and you see commodities just screaming higher. I mean, commodities have outperformed stocks this year, which is good for us. I mean, our portfolios always have commodities in them, so we're happy to see commodities benefit our portfolios. That's why we put them in there. We have an embedded inflation protection within our portfolios all the time. It's part of our strategic approach to investing. But I'm not sure that the message is really all that different. In fact, I think they actually make a lot of sense. The bond market is saying that the long-term outlook, the long-term growth outlook, is not that great. Well, we've talked about this many, many times. That what makes growth over the long term is productivity growth and workforce growth. The real big news last week, and I'm probably stealing one of your questions here, Bob, but I'm going to do it anyway. Well, the big news last week was actually that the number of births in the United States hit a low not seen since 1979 last year, and the birth rate Peaked in 2007, is down almost 20% since then. So we're not going to get any tailwind from workforce growth for sure when it comes to economic growth. And then you got to look at productivity growth, and productivity growth has been weak for this entire last decade, and it doesn't seem like it's improving. So when you look at those things, the bond market, the 10-year, looking at a 10-year Treasury note, makes perfect sense for it to be at a low yield because we don't expect very good growth over the next 10 years. But commodity markets are kind of responding to a completely different thing. It doesn't really have to do with growth. It has to do with the supply side of the commodity complex or the supply side of the economy. We just came through a decade where commodity prices basically went straight down. Nobody was investing in new capacity. You're not digging any new copper mines when copper just goes down. You're not doing you're not adding mills. And if you're talking about wood, since that seems to be a topic of popular discussion, two by fours cost a lot these days. But we weren't adding mills when people weren't using boards. So part of the problem here is that you've got a lack of investment over the last decade in commodity capacity. And the second thing is that we've got a reopening of the global economy where you get a return of demand because demand's easy to come back. People always want stuff. The supply side is taking longer, in particular with commodities where a lot of them get produced in emerging markets where they're still having problems with the virus. I'm not sure that Brazil can keep miners in the iron ore mine to keep prices from going up, to keep supply coming in. So, I mean, that to me has nothing to do with long-term growth. That has to do with a short-term phenomenon. Some of it may be long-term in that we do need to add some capacity, but I don't think that's the big issue. And when we look at stocks, well, stocks respond to corporate earnings. Corporate earnings are not really correlated with economic growth in the short term. We're going to get a big rebound in corporate earnings. We know that. The stock market reflects that. Now, I think it's probably well beyond we're just reflecting what the rebound in corporate profits is going to be in the short term. But we don't know what's going to happen long term. We don't know what's going to happen to corporate profits. We don't know, for instance, what's going to happen with corporate tax rates or anything like that. So I think that's a difficult thing to figure out. So I don't know. Yeah, there is some conflicting signals, but they're not that much in conflict.
Hey, tell me what you think about that big miss on the payroll numbers last week.
Well, it was certainly a big miss, but I actually don't find it surprising. Jeff Snyder wrote about this stuff. He's been looking at jobless claims and the JOLTS figures, and he came out with an estimate of about 500,000 or 600,000, which still turned out to be high, but it was a lot closer than the million that everybody else was looking for. Look, the jobs market is going to take some time to recover. This is not going to happen quickly. Look, there's a whole bunch of things that go into this. I hear a lot of people talking about unemployment benefits being generous. Well, we see this every cycle. This is not new. Employers claim that they can't find workers. Well, you can find workers if you're willing to pay them. If you're not willing to pay them, then no, you're probably going to have a problem finding people to work. The unemployment benefits are always generous coming out of recession. That's the way it works. It happened in the last cycle too. So I don't see anything that surprising about those things. It'll get resolved eventually. The unemployment benefits will run out in September. In the meantime, there are enough good people in this country who are going, I don't want to be on unemployment benefits. I want to work, even if it's the same amount of money. But you're going to have some layabouts who want to just keep collecting a check and playing video games. And that's just, again, you can't change, human nature. So I don't know. The employment number was low, but look, I remember a number. This was many, many years ago. I don't remember exactly when it was, but I remember it was an August payroll report. And this was sometime in the last decade. And I remember it was early in this decade. And I remember the number came out and it was a negative number. It was like a minus 50 or something like that when the expectation was like a plus 150. And the market just tanked on that number. Well, by the time the thing finally got revised, it actually turned out to be a plus 150. And that was one of the things that taught me a long, long time ago that really all you want to look at on these numbers, especially with this first pass on it, is the sign. Is it up or down? Because anything beyond that is just it's the accuracy on these things is just not even close. And I can't imagine that during the pandemic that it's better. If anything, it's worse. These things are done by surveys. It's just not very accurate. So I pay attention to the sign. Is it up or down? If it's up, then that's good. If it's down, that's bad. That's all you really need to know. It was a plus this week, or this month. Maybe not plus as much as we'd like, but it was plus. So that we'll take that as a good.
Hey, last thing today, I know you're seeing some numbers, some issues between supply and demand, and it's global. It's not just the U.S., but especially in things like semiconductors to autos. What does that tell you?
Well, I think that I think first of all that the idea that put it this way, it seems to me that we look at some of the data that came out last week, the ISM reports in particular, and it looks like that the rate of change on the recovery is peaking or may have already peaked. So in other words, the big upswing, maybe that part of this is over. But I think it's a supply limitation. Look, we did 18.5 million annual rate on light vehicle sales, which is light trucks and cars, in the month of April. So in April, we did 18.5 million, but we know too from Ford's quarterly report that they are going to have production that's going to be about half this quarter what they were expecting. So I don't see any way we can maintain that 18.5 million rate. And that's a supply issue. They don't have chips. They don't have parts. We're also seeing some layoffs in the auto industry because of this. And it's not just the automobile industry. It's other industries as well. Like I said, the supply side of the economy, this recession was a supply shock. It's going to take time to get the supply side of the economy restored. And until it does, it's going to limit our growth. But I was thinking about this. I'm not sure it really is a bad thing. I would rather get 3 or 4 quarters of 3 or 4% growth rather than get 1 quarter of 12 and then go back to 2. I think if the longer you stretch out the recovery, I think that might be better. I much prefer a more steady approach that way. So I don't know. We'll see how it comes out. But that to me is really, I don't know that it's that big a deal. I think it's just that growth rate coming out of in the recovery is maybe peaked, and that's about it.
All right, thanks, Joe. We'll check in with you again next week.